Stock market's got a little wobbly this week. I don't really think that's surprising given some of the things we've been talking about here more recently. One of those things, of course, being the reverse repo facility. That's basically drained. We talked about this in a weekend video. Today it actually ticked a little higher to 35 billion. Could tick a little bit higher throughout the week as we see some government-sponsored entities enter the fray. But essentially at this point, this facility has no major market impacts on it. No major market impact at this point. All this excess liquidity has been drained. And so what you're seeing right now in the market is an S&P 500 that's trading in an environment that doesn't have these liquidity buffers anymore. Here's a really good example of what I think's been happening. In fact, you can see that the stock market for some time here has been rising with as reverse repo facility has been draining, and that's because when the reverse repo facility goes down, it helps to increase reserve balances held at the Fed. We have to remember that the reverse repo facility is a liability, and so when it goes up, it drains reserves from the Fed, and when it goes down, it adds reserves back to the Fed. Now, the bigger problem here is that the reverse repo facility is drained and the Treasury is still issuing lots of debt. So we have lots of Treasury issuance still coming up over the next several months. And so we've really just started to see the beginning of it. And in fact, on Wednesday, when we saw that big drawdown in the S&P and the NASDAQ, that was a Treasury settlement day. Friday was a Treasury settlement day. Thursday was a Treasury settlement day. So a bunch of the days where we've seen the market draining, those have been associated with Treasury settlement days. And so this is something we're going to obviously want to keep track of, because if the money and the liquidity is no longer coming from the reverse repo facility, well, then where is it coming from? And that's really going to be a big question for us to figure out over the next 6 weeks, because I think we have about 6 weeks before we get to the point where the TGA, the Treasury General Account, is going to be back at that $850 billion mark. And essentially the way this is worked over time is that when the TGA is rising, typically you see weakness in the S&P 500. And without the buffer of reverse repo facility offsetting that, this liquidity is going to come directly from reserve balances. And as the TGA continues to rise, that could weigh on the S&P 500. But the problem is once we get to 850 billion, and the Treasury TGA is basically filled, we're no longer going to see reserve balances necessarily hit. It's probably going to go and it's going to start hitting, money market type institutions. It's going to start draining liquidity from dealer balance sheets. And so, right now, the best way we can kind of keep track of all of this is by using some of these intraday tools we have to really track liquidity. And to this point, it's really too early, but the standing repo facility is certainly one place we would see activity pick up if we started to see liquidity really tighten the overnight funding market. For that really to be activated, though, we need to see the general collateral rate go over 4.5%. And as of today, at least, we weren't really there yet. In fact, the average repo rate today was only around 4.36. And so it's quite possible that tomorrow we get SOFR, which comes in at 8 a.m., to be a little bit lower than where it was today. So, these are some of the liquidity problems that we face. One of the other things, obviously, is, how is equity financing going to be affected if dealers have to start taking on treasuries? We know that equity financing in the repo market has become a new thing since, I would say, the fall of 2023. This is a chart that shows primary dealer holdings of equity repo financing, and really it's traded quite a bit with the S&P 500. In fact, the similarities are quite strong. And, we basically last week we saw a really big drop in the activity. This is a really hard number. I was going over this today with my members in the YouTube area and other places like Substack and Seeking Alpha. When we were talking, I was telling and explaining to them, I can't really predict this number. And so I don't really go over it a lot, except for when there's a major change in it. And at least as of last week, we saw a pretty big drop in it. So we're going to want to see this week, when this comes out on Thursday afternoon, what happens here, whether or not we continue to see this drop, or we see some sort of rebound. Obviously, if this keeps dropping, this is a sign that there's probably some constraints on primary dealers' books, and that perhaps they're going to be lending less in the future. and that could really begin to tighten things like margin balances. Um, in fact, when we look at total positioning of securities by dealers, we can see we're at record high levels, which I guess shouldn't be too surprising given that the Treasury debt is at record high levels. But more importantly, you can see we pulled back a little bit. We're going to want to see and watch to see if this number really starts climbing in a much more meaningful way now that the reverse repo facility is drained. And so generally speaking, when we look at, the market, we can tell that there's some sort of liquidity strains going on. That's really what I think is sort of impacting the market here. Certainly when you look at a stock like Palantir, it has the look of a stock that's getting hit in a way that would suggest there's maybe something going on from a deleveraging standpoint. Other things that I've been watching in the market and reviewing with subscribers of the area is really a lot with the Japanese yen. These spreads are really getting to a very vulnerable point. In fact, you can see that right now the spread on the 10-year minus the Japanese 10-year is sitting right on support. And this is important because we've seen a little bit of a divergence more recently between the yen and the spread. And so this is going to be something we're going to need to watch because, again, if this spread starts breaking down in the form of the Japanese 10-year or the Japanese 5-year rate beginning to rise, I would have to think that the Japanese yen would need to begin to strengthen a little bit because these spreads are really contracting. And anyone that has one of these carry trades on is probably not earning quite as much as they had been in the past, given where the spread is today versus where the spread had been, even as much as April of 2024. So again, we're going to continue to keep an eye on this, but you can also see this is the case with the 5-year in Japan. And in fact, when you look, you can see that the 5-year spread actually closed at its lowest level basically since July of 2022. So again, we're at a point here where, these spreads are really contracting. And when you look at a Japanese 5-year rate, I mean, it's kind of butting up against resistance here at the 115 level. I mean, if we're playing technical analysis, which is what we kind of do at times, right? It almost looks like there's an ascending triangle that's formed. The question really becomes is how high can the rate go if it does break out? And the problem is we don't really have a lot of history here when it comes to these charts on TradingView. But I mean, a breakout above this 114 area certainly could lead to a move back towards 125. It could even lead all the way back to 154. And if you start getting a 5-year rate moving up to 154, that's going to do even more damage on that spread that we were just looking at. And it's really the same thing on the 10-year. When we look at the Japanese 10-year, that is, you can see it's a very similar pattern. In fact, the Japanese 10-year yesterday closed at its highest point since, you got to go all the way back to 2008. And again, it looks like with a breakout, you could get a move all the way up to 170 or 186. And that's also going to really be a weight on that spread. And when you look at the, when you look at the Japanese 30, you're also getting really close to breaking out. You can see we've been testing this area now about 3 times. When you look at the Japanese 40-year, that also looks like it's breaking out a little bit of a pennant. So there's a possibility here we could see this go significantly higher, maybe even back up towards this 380 level. So these are things that are happening in the market right now that are having a fairly big impact on this trade. And this is why I really have been focusing quite a bit on it. And then I guess finally, the thing we were talking about a lot over the summer months, in July, I should say, was this, implied correlations and everything that was happening here. And clearly we've seen implied correlation rates get to really low levels. And, right now we're starting to see signs of them beginning to move up again. And so we're going to want to keep an eye on this as well, because we know that the S&P 500 trades inverse to these implied correlations. And when implied correlations rise, stock prices move down. This has consistently happened over time. And today we also saw the VIX move up just a little bit. If we're going to start seeing more volatility in the market, you got to think implied volatility starts going higher. So that's kind of what we're watching right now and going over on a regular basis. If you find this interesting, please check out my member area here on YouTube. Otherwise, have a great rest of your week, and we'll see you over the weekend. Bye.